My stock that Paul's not going to buy, and it's probably no bad thing, is a bank. We were talking about it earlier, or at least talking about this segment earlier in like the first time that we've actually discussed anything in advance of the show in, well, must be about 12 months or so now. But Paul knows it's a bank, and I said it wasn't Citigroup, and I said it wasn't Barclays, and he said unless it's the obvious Bank of America, it's either some random regional thing or else it's Canadian, was what he said. And he's correct. It is, in fact, the obvious Bank of America. But you don't own this, do you?
Nope.
Good. You own JP Morgan, so I had to try and find a reason to not choose that. But let's talk about Bank of America a little bit then, because when I looked at this more and more, I was sort of surprised that you don't own this, because it feels to me like what I think about when I think about dividend growth investing. So let's start from the beginning then for the moment. It's a bank, so it has two revenue streams. And in the case of Bank of America, they're roughly even sized according to their last 10Q. They're not always, but they were in the most recent one. So there's this thing called net interest income, which is what happens when you take in deposits and pay some interest on them and lend out money and get some interest back on them. So current account deposits versus mortgages. And you make it money by lending it out at higher rates than you take it in at. That's where your kind of net interest income comes from. And the other way you make money as a bank is by basically charging people for stuff. So that's fees, and that could be credit card fees or wealth management fees or investment banking fees or any of that. And these two parts of Bank of America's stuff, they wax and wane depending on the macroeconomic environment. But at the moment, they're roughly even. So let's have a look at the two bits of them separately then. Net interest income, the lending in and out stuff, basically. So what do you need to be good at this? Well, you need two things. And fairly obviously, you need the ability to get in deposits fairly cheap, and you need the ability to lend them out pretty much at size, importantly. So interest rates will determine what kind of return you can get on them, but being able to lend them out at scale is kind of useful. So Bank of America ticks some boxes here. It has a pretty large branch footprint. It's the third largest in the US behind, you can probably tell me which ones, Steve?
I would go with JP Morgan or Chase, I would assume, because they bought quite a large branch network with that, and I would say Wells Fargo.
You would be correct in both cases, but I'm not recommending JP Morgan and I'm not recommending Wells Fargo. Wells Fargo is currently restructuring its mortgage stuff, and I haven't had time to think about that yet. And JP Morgan Paul already owns, so that's not allowed. But nonetheless, third biggest is Bank of America, and they have some pretty good scale here. And one thing they've been working on recently is trying to join up a lot of their services. So by expanding their kind of footprint in branches, they're trying to join up places where they might have current accounts and mortgages, but not credit cards, or the other way around, and providing people with investment saving services where they currently have a big credit card present, that kind of thing. They are apparently more so than JP Morgan or even Wells Fargo, one of the most interest rate sensitive banks, which is an interesting thing to be at this current time because interest rates are going up. And we saw today that economic data from the US, indicates that inflation is coming down, but it's still fairly high, and I think rates have some way to go. And I think Bank of America stands to be a fairly big kind of beneficiary of this. The usual worry, and we heard this from a kind of UK Squawk Box interview earlier, is that if rates get too high, the problem you have is that people start defaulting on their mortgages all over the place. And that thing that looked like an asset on your balance sheet as a bank suddenly turns into a massive great hole on your balance sheet as a bank. And this has happened a lot around sort of 2008. But Bank of America has worked quite hard, along with a lot of other banks in fairness, but them in particular, to rebalance themselves away from subprime and consumer lending since sort of 2008. They're non-performing loans, so these are loans that are about 90 days past due, are less than 1% of their total. They're less than 0.5% of their total, actually, and their net charge-offs. So net charge-offs basically are loans that are pretty much delinquent, not just overdue. And net charge-offs here is the value of the loans that they've pretty much had go delinquent, minus anything they've managed to recover on that, is about 0.2% of their total. That's not too bad. They have, like every bank, a massive cash allowance put aside to cover loan defaults. That covers about 1.2% of their loans. Is that likely to be enough? Well, I was reading the Morningstar forecast. They're looking at about half of that in a kind of worst case scenario. So I guess they're reasonably well covered for staying out of actual trouble. So the lending side looks all right to me here. That takes us on to the kind of fees and stuff side. So what do you need to be good at fees and stuff? Well, you need to be pretty big. basically. You need to be able to offer size, you need to be able to offer scope, and you need to be able to go and get people and find ways that are convenient for them. So they're a top 4 credit card issuer. They have Merrill Lynch for their investment stuff, which they bought back after the kind of collapse of that bank, more or less. And its raging size gives it a big joined-up force of investment services and brokerage and credit card and everything that commands fees, basically. So what they can do is bring loads of their stuff under the same roof, which is convenient and helpful, and people generally join up to their stuff and don't switch very easily, so it seems. Anyway, enough about the kind of boring qualitative stuff. Let's get on to the things that dividend growth investors care about, which is valuation and dividends. So here's how you value a bank, more or less. You take the return on equity, and then you work out what you want as a return, and then you work out what you have to pay for that equity in terms of a price to book. So Bank of America has a return on equity of just over sort of 10% or so. It's a price to book of about 1.1. Last time I looked, it might be up to 1.15 now. So that takes you to a sort of 8-9% return per year. It's got an interesting kind of buyback and dividend approach here. So over the last 10 years, it's paid out 46 billion, as rounded down slightly, in dividends. And that's grown by, well, Paul, what would you consider to be a good dividend growth rate over 10 years?
To be honest with you, I think I already know that. Isn't Bank of America's already like 5%, something like that, which is reasonable?
It's growing a lot faster than that. It's been growing by about 36% over the last 10 years, partly because it started from nearly nothing. But it's been growing at 17% on average over the last 5 years. And it's easy to grow your dividend like that when you do what they do, which is buy back a hell of a lot of stock. So if you're a dividend investor and you're looking at Bank of America's dividend and you're seeing it yields about 2.5%, maybe slightly less now because the shares moved up a little bit, you would be missing, I think, about 2/3 of the returns picture here. So they've sent out about 46 billion in dividends. They've spent 96 billion on buybacks over the last 10 years, which has brought their share count down a lot, which means the same dividend pool goes over, as Steve was kind of hinting before, a lot fewer people, which means there's a lot more going on in dividends per share. And I'm not sure they're going to stop anytime soon. They don't look like they're in any distress. They don't look like they're in a particularly big restructuring thing. I'm expecting their share count to keep coming down and down and down. I'm expecting their dividend to keep going up, both in kind of absolute terms of amount of money coming back and in kind of, I guess, diluted terms across the number of shares. I think this is going to keep growing. If I were a dividend growth investor and I wanted something that paid a kind of all right dividend now and I thought pay more of one in the future, this would be my choice.
Dividend growth is slowing down. Like you say, since 2015, it's been like 66%, 25%, 56%. But in the past 3 years, it's more like 9, 8, and 10%. So the actual growth in most recent years is slowing slightly. But like you say, average before that has been very, very high, 56%, 66% dividend growth, which has been crazy. That must be when it started repaying after the crisis, right?
Yeah, so 10 years ago takes us back to about 2013 or so, which is when things started really kind of working their way, and it's been working quite hard to sort of write its loan book, pay off, sell off various bits of stuff, use that to buy back shares, push its dividend along.
Yeah, you can see in 2009 minus 98% dividend growth, which is quite funny. Just interesting seeing that all there. Dividend growth isn't the be all and end all, though. It's pretty. You've definitely looked into Bank of America. Are you doing some bank stock viewing at the minute, or is this just a hobby of yours?
I'm sort of in two minds, to be honest. It feels a little bit like the wrong time to be buying bank stocks, but I can't help but find myself getting kind of drawn towards them. The trouble with the moment, for my own kind of portfolio at the moment, and I've said this to Steve, and I've said it on this channel, and I've said it to pretty much anyone that will listen, and several people who won't. It's kind of hard to look beyond US big tech and the FANGs at the moment in terms of valuation. I mean, I own a bank. The bank I own is Citigroup. I like Bank of America here. If someone said to me, look, what's the problem with this? Why aren't you buying it? The only reason I would say is I think there might be things that are better value right now, are trading at kind of better prospects right now in this particular environment. It's one of the stocks I'm annoyed at myself for not getting into in a bigger way 2 or 3 years ago during the pandemic, because it was better positioned than people were giving it credit for. It was down at around $25. I did buy part of it. I subsequently sold it. I rather regret that, to be honest, but that was... I sort of regret it, sort of see it as part of a learning process, to be honest. It was just a kind of slightly further back in my thinking stuff about this. And I never really put the energy in to try and figure out exactly what its competitive advantages are and so on. So that's Bank of America for me anyway.
You mean you get plenty of exposure to it through Berkshire Hathaway as well, though, don't you? So it's not like it's left you.
No, I did kind of reason that way as well, I think, and I went off and bought MasterCard instead, which I also don't have anymore.
Yeah, interesting.
I think this is the first time I've picked a stock that you might actually kind of like, at least since that utility thing.
Yeah. And just looking like at the past performance as well, and it's another blue chip. I've been looking today quite a bit at blue chips and how they perform against the S&P 500. It's another blue chip over 10 years. Outperforms, and this really common theme. I'm wondering if in the S&P 500 the reason why some stocks don't perform is they simply go bankrupt and the rest just outperform. And it's kind of, and that's just something. Obviously that's not the case, but it's just really interesting that some of these stocks, particularly the better ones that show great. Is it always dividend growth? It's not always dividend growth, but these stocks just outperform. It shouldn't be that hard to outperform the market, considering every single one I'm looking at right now outperforms historically.